Welcome to Market Brief After Hours. We have a lot of ground to cover today. Global markets ended the week under severe pressure, and the mood on Wall Street is decidedly cautious. We are seeing a complex web of rising geopolitical tensions, surging energy costs, and some incredibly concerning economic data. Let's start with the big picture. What were the main takeaways from this week's market action?
The central narrative right now is the escalation of the Iran conflict and what that means for the Strait of Hormuz. Energy supply concerns are front and center, pushing crude prices significantly higher. We are seeing Brent crude up 2.67%, settling at $103.14 per barrel. That is the second consecutive close above that critical $100 psychological level. West Texas Intermediate is right behind it, climbing over 3% to finish at $98.71.
And it seems like policy interventions aren't doing much to cool those prices down.
Exactly. The International Energy Agency tried to step in, releasing 400 million barrels from global reserves, but the market practically shrugged it off. Supply disruptions are just too severe. And the real fear here is how these elevated energy costs will bleed into the broader economy. It is a textbook recipe for driving up inflation while simultaneously slowing down economic growth.
That brings us perfectly to the U.S. equity markets, which really struggled to find any footing. Let's run through the major indices.
It was a rough week across the board. The Dow Jones Industrial Average fell 0.26%, closing at 46,558. For the week, the Dow has declined roughly 2%. Then you have the S&P 500, which slipped 0.61% to close at 6,632. That drop leaves the S&P roughly 5% below its recent high. It also marks a 1.6% weekly decline, which is its first three-week losing streak in about a year.
And the tech sector took an even harder hit, right?
It did. The Nasdaq Composite fell 0.93%, finishing the session at 22,105. Technology shares are highly sensitive to shifting expectations for interest rates. And with energy costs rising, investors are rotating away from high-growth sectors. The Nasdaq dropped about 1.3% for the week as a whole.
Let's dig into the why behind those shifting interest rate expectations. We received some major U.S. economic data today, and it paints a pretty difficult picture for the Federal Reserve.
It really is worst-case scenario for central bankers. U.S. fourth-quarter GDP growth was revised sharply lower. It expanded at an annualized rate of just 0.7%. That is down from the previous estimate of 1.4% and well below Wall Street's expectation of 1.5%. To put that in perspective, the economy grew at 4.4% in the third quarter of 2025. So economic momentum is hitting a brick wall.
But inflation isn't cooling down with it.
That is the sticking point. The Personal Consumption Expenditures Price Index, the Fed's preferred inflation gauge, rose 0.3% in January, putting the annual rate at 2.8%. Core PCE, which strips out food and energy, increased 0.4% for the month and 3.1% year over year. That is higher than December and still comfortably above the Fed's 2% target. So growth is slowing dramatically, but prices are still climbing.
Looking at the bond market, how did Treasury yields react to that mix of weak growth and sticky inflation?
Yields were relatively muted, but you could see the internal tug-of-war. The benchmark 10-year Treasury yield rose slightly to 4.285%, and the 30-year yield ticked up to 4.91%. However, the policy-sensitive 2-year yield actually slipped to 3.734%, which tells us traders are actively reassessing how aggressive the Federal Reserve can really be in this environment.
Let's cross the Atlantic. The energy squeeze is arguably an even bigger threat to Europe. How did European markets fare?
They slid right alongside the U.S. The Stoxx 600 closed down 0.5%, with almost every regional market posting declines. In France, the CAC 40 dropped 1.01% to 7,904. Germany's DAX fell 0.78% to 23,406, and Italy's FTSE MIB declined 0.36% to 44,297. Over in the UK, the FTSE 100 slipped 0.43% to 10,261, while Switzerland's SMI edged slightly lower to 12,839.
And the economic data out of Europe isn't offering much hope either.
Not at all. UK GDP completely stalled. It came in at 0% month-on-month for January, missing forecasts for a 0.2% increase.
And the Eurozone is really feeling the industrial pain from these energy costs. Industrial production there fell 1.5% month-on-month in January. They were expecting a 0.5% increase, so that is a massive miss.
It's a global theme. Even the Asia-Pacific markets retreated on fears of a prolonged Middle East conflict. Japan's Nikkei dropped over 1%, South Korea's Kospi slid 1.7%, and India's markets had their biggest weekly declines in years. We are going to take a quick break. When we come back, we will dive deep into the Forex markets, look at some critical moving averages, and break down the single stocks making massive moves today. Stay with us. Welcome back to Market Brief After Hours. Let's pivot to the foreign exchange markets. The currency charts are showing some extreme momentum shifts right now. Let's start with the euro.
The euro is breaking down significantly. Euro USD closed at 1.1417, falling 0.83%. It printed a massive bearish candle, meaning sellers dominated the session from open to close. What is critical here is where the price sits relative to its moving averages. It is now firmly below the 50-day simple moving average at 1.1745, the 100-day at 1.1691, and the 200-day at 1.1673.
So all those previous support levels have flipped to resistance.
Exactly. All three of those major moving averages are now sitting overhead as resistance, confirming a structural shift to a bearish medium-term trend. The next downside focus is around the 1.1350 level if this selling pressure keeps up.
What about the British pound? Is it a similar story?
Very similar. GBP USD slid 0.9% to close at 1.3224. It also formed a strong bearish candle. Price is well below its 50-day moving average at 1.3520, the 100-day at 1.3397, and the 200-day at 1.3441. The breakdown extends a corrective phase that started back in February, establishing fresh swing lows. Immediate support is at 1.3219, but it could easily test the 1.3150 region soon.
Let's look at the commodity-linked currencies. The Australian dollar took a heavy hit today.
It did. AUD-USD dropped sharply, falling 1.37% to close at 0.6979. It was a sharp reversal lower after a period of consolidation. Right now, it is testing a crucial level, the 50-day moving average at 0.6954. It actually dipped below it during the session before bouncing slightly. The broader trend is still supported by the 100-day at 0.6764 and the 200-day at 0.6649, which are well below current prices. But losing that 50-day average would be a major red flag.
And then we have the Canadian dollar, which actually showed some strength against the greenback.
Yes, USD CAD rebounded strongly from recent lows, gaining 0.6% to close at 1.3720. Buyers really defended the 1.3550 support area earlier in the week. This move pushed the pair back above its 50-day moving average at 1.3698. However, it still has to contend with a major resistance zone overhead, formed by the 200-day moving average at 1.3799 and the 100-day at 1.3810.
Before we move on to equities, we should briefly touch on the precious metals. Gold and silver both pulled back today.
Gold closed at $5,018, falling 1.18%. It's a deepening correction from those recent record highs, but the broader bullish trend is fully intact. It's still trading way above its 50-day moving average of $4,925, and its 100-day and 200-day averages are sloping upward aggressively. Silver, however, slid much more sharply, dropping nearly 4% to $80.59. That was a decisive break below its 50-day moving average at $86.31, reflecting intense selling pressure.
All right, let's wrap up with our market movers. We had some dramatic single stock stories today. Ulta Beauty led the losers on the S&P 500. What happened there?
Ulta shares plummeted 14%. The retailer issued its full-year sales growth forecast, and it completely failed to meet Wall Street's consensus. In a market this cautious, any sign of consumer weakness or forward-looking pessimism is getting punished severely.
On the flip side, Klarna Group had a fantastic day.
Klarna climbed 9%. This was driven by a regulatory filing that revealed a substantial share purchase by the company's chairman. Insider buying is always a strong signal of confidence, and in the turbulent market, investors flocked to that kind of conviction.
There was also some major executive news over at Adobe.
Yes, Adobe shares fell 7%.
The software giant confirmed that CEO Shantanu Narayan will be stepping down from his role once a successor is found. He has been a foundational figure for the company, and leadership transitions of this magnitude always inject uncertainty into the stock.
We also saw a significant drop for Insulet.
Insulet finished 6% lower. They had to issue a voluntary recall for their Omnipod 5 medical devices due to manufacturing defects. Recalls are costly, both financially and in terms of brand reputation, so the market reacted accordingly.
Finally, despite the broader market sell-off, crypto-linked stocks actually caught a bit today.
They did, acting as a bit of a safe haven, or at least an uncorrelated asset in today's session. Bitcoin rose more than 1% to hit a one-week high, and the related equities followed suit. Galaxy Digital Holdings gained over 8%, Mara Holdings rose more than 6%, and both MicroStrategy and Coinbase Global posted gains of over 1%.
It really has been a complex week. Between oil surging past $100, growth slowing down, and inflation refusing to budge, investors have a lot to digest over the weekend. The policy outlook is incredibly uncertain, and all eyes will be on the Persian Gulf and the upcoming economic data. Thank you for tuning in. If you find this useful, please follow Market Brief After Hours.